You are standing in your kitchen, holding a letter that looks deceptively simple. It is not from the Royal Bank of Canada. It is not from TD or Scotiabank. Those doors closed on you a year ago. This letter is from a company you might have never heard of until your mortgage broker introduced them as your savior. It is from a private lender, or perhaps a mortgage investment corporation. For the last 12 months, you have been paying them an interest rate that makes your stomach turn. 10%, maybe 12%. You have been scraping by, cutting every expense, waiting for the day you could go back to a major bank. You were told this was just a bridge. You were told it was a temporary fix to repair your credit or wait out the high rates. But today, the bridge has collapsed. The letter does not offer a renewal, and it does not ask for a higher rate. It says two words that are becoming the most terrifying phrase in the Canadian housing market. Renewal rejected. The lender wants their money back. All of it. In full. By the end of the term, which is likely just weeks away. Welcome back to Canada Property Watch. In our last investigative report, the audit, we exposed how the major banks are using artificial intelligence to detect fraudulent income documents and kick thousands of borrowers out of the prime mortgage system. We told you that when the big banks recall your loan, you have nowhere to go but down. Today, we are going to talk about what happens when you hit the bottom. We are going to talk about the shadow banking system, the world of private lending, B lenders, and mortgage investment corporations. For years, this was the safety net for desperate borrowers. It was the place you went when the bank said no. But now, that safety net is being set on fire. We are witnessing a silent liquidity crisis that is forcing private lenders to dump tens of thousands of borrowers onto the street, triggering a wave of forced sales that will make the 2008 crisis look like a dress rehearsal. To understand why this is happening, we have to understand the psychology of the shadow market. When a borrower gets rejected by a bank like CIBC or BMO, usually due to the stress test or bad credit, they don't just give up and sell the house. They panic. They call a mortgage broker and ask for a solution. The broker says, I have a private lender who will give you the money. The rate is high, maybe 10%, and there is a 1% lender fee, but it will keep you in your home for another year. By next year, rates will drop, your property value will go up, and we will move you back to a bank. This is the standard sales pitch. It is the bridge loan theory, and for a long time it worked. As long as house prices were going up, private lenders were happy to keep renewing the loan. They felt safe because there was equity in the home. But the math has changed. The equation is broken. The private lender is not a charity. Often, the lender is not even a big company. It might be a retired dentist, a group of lawyers, or a syndicate of small investors pooling their savings into a MIC, a mortgage investment corporation. These investors were promised a steady return of 8 or 9%. They thought real estate was safe, but now they are watching the news. They see prices falling in the suburbs of Toronto and Vancouver. They see listings sitting on the market for 90 days, 100 days. They see the power of sale signs multiplying, and they are scared. This is where the shadow bank run begins. Unlike a major bank, which has deposits and government backing, a private lender relies on investor capital. When those investors get scared, they ask for their money back. This is called a redemption request. Right now, MICs across Canada are being flooded with redemption requests from their investors. The investors want out, they want cash. But the MIC doesn't have cash. Their money is tied up in your house. It is tied up in thousands of mortgages that are barely making interest payments. So, how does a private lender get liquidity to pay back their angry investors? They have only one option. They have to call the loans. They have to stop renewing mortgages. When your 1-year term is up, they cannot offer you an extension, even if you have never missed a payment. They need your principal balance back to pay out the retired dentist who wants to take his money and put it into a GIC. This is why you are getting the renewal rejected letter. It is not personal. It is a liquidity crisis. The lender is bleeding, and to save themselves, they have to sacrifice you. Let's walk through the nightmare scenario that unfolds after you receive that letter. You call your broker in a panic. You say, find me another lender. I can't pay back $800,000 in 3 weeks. The broker starts making calls, but he finds that the door is closing everywhere. The other private lenders are facing the same liquidity crunch. Or, if they are lending, they have tightened their loan-to-value ratios. 2 years ago, they would lend up to 80% of your home's value. Today, they might only lend 65%. This is the appraisal trap. Let's say you bought your home for $1 million. You have an $800,000 mortgage. That is 80% loan to value. But now the market has dipped. Your home is appraised at $850,000. The new private lender says, I can only give you 65% of the current value. That is roughly $550,000. But you owe $800,000. There is a shortfall of $250,000. To close the new deal, yet you need to come up with that cash immediately. But if you had $250,000 lying around, you wouldn't be in this mess. So, you are stuck. You cannot renew with your current lender. You cannot refinance with a new lender. You are trapped in the shadow banking death spiral. And this is when the fees start to eat you alive. This is the part of the story that nobody talks about until it happens to them, the fee shock. When you go into default with a private lender, the clock starts ticking much faster than with a major bank. A major bank cares about its public image. They have PR departments. They move slowly. A private lender does not care. They are often aggressive asset managers. The moment your term expires and you haven't paid, they send the file to their lawyers. You are now responsible for their legal fees, and these are not standard legal fees. These are enforcement fees. Let's look at the cost of trying to stay afloat in the private market for just one more year, assuming you could find a lender. First, there is the interest rate. Private mortgages are often interest only. You aren't paying down any principal. You are just renting money. At 12% on an $800,000 loan, that is $8,000 a month, $96,000 a year, just in interest. That is post-tax money. You need to earn $140,000 a year just to pay the interest on your house. Then come the fees. Every time you set up a private mortgage, there is a lender fee, usually 1 to 2%. On $800,000, that is $16,000. Then the broker fee, another 1%, another $8,000. Then the legal fees for both your lawyer and the lender's lawyer, another $5,000, plus appraisal fees, plus admin fees. You are looking at $30,000 in upfront cash just to sign the papers. Add that to the $96,000 in interest. You are burning through $126,000 a year to live in a house you technically own, but actually engage in a financial battle to keep. For many Canadians, this is the end of the line. They have burned through their savings trying to keep up with the variable rate trigger point. They have tapped out their credit cards. They have borrowed from family, and now, facing a $30,000 renewal fee and a 12% interest rate, they simply break. And they cannot do it, and that is exactly what the private lenders are counting on. In fact, some predatory lenders prefer that you default. Why? Because of the equity strip. When they force a power of sale, which is the Canadian term for foreclosure, they take control of the sale process. They list the property, they sell it, and then they start deducting. They deduct the principal. They deduct the accrued interest. They deduct the default management fees. They deduct the property management fees for cutting the grass while it was listed. They deduct the real estate commissions. By the time they are done, a homeowner who thought they had $200,000 in equity might walk away with a check for $5,000. Or worse, nothing. Or even worse, a bill. If the house sells for less than the debt plus fees, and the lender can sue you for the difference. This is called a deficiency judgment. You lose the house, you lose your equity, and you still owe the lender $50,000. They can garnish your wages for the next 10 years. This is the final trap. We are seeing a massive spike in these cases in the court system right now. In Ontario alone, power of sale listings have skyrocketed. But you won't always see a power of sale sign on the lawn. Private lenders are smart. They know that a foreclosure sign kills the property value, so they force the borrower to sign a consent to sell. It looks like a normal listing on MLS, but if you look at the seller instructions, it says Schedule B required. It implies a bank is pulling the strings. Who are the people falling into this trap? It is not just the speculative investors. And it is the Henry demographic. High earner, not rich yet. It is the family making $200,000 a year who bought a suburban home at the peak. They qualified with a B lender because they were self-employed or had slightly high debt ratios. They thought they could handle the payments, but they didn't account for the renewal wall. They didn't account for the liquidity crisis in the private sector. The real danger here is the contagion effect. When a private lender forces a sale, they are not motivated to get the highest price in 6 months. They want the money now. They want to satisfy their redemption requests. So they list the house for a quick sale. They undercut the market. They list it for $50,000 less than the neighbor. When that house sells, it sets a new comparable for the whole street suddenly, and everyone else's house is worth less. This lowers the loan-to-value ratio for the neighbors. When the neighbors go to renew their private mortgages, their lenders see the drop in value and say, renewal rejected. It creates a feedback loop, a doom loop. More forced sales lead to lower prices, which lead to more rejected renewals, which lead to more forced sales. This is why the private lending collapse is actually more dangerous to the housing market price floor than the big bank defaults. Big banks can afford to wait. They can offer extend and pretend amortizations. They can stretch your loan to 90 years if they really want to avoid booking a loss. Private lenders cannot. They do not have the balance sheet. They are cornered animals, and a cornered animal bites. Let's talk about the Mortgage Investment Corporation's MICs again. Because this is a huge part of the story that is flying under the radar. Many Canadians have their retirement savings invested in MICs. They were told it was a safe alternative to the stock market. Mortgages are secured by real estate, they were told. It's brick and mortar. But what happens when the MIC pauses redemptions? We are seeing major MICs sending letters to their investors saying, due to market conditions, we are freezing withdrawals for the next 6 months. Imagine you are a retiree. You need that money for living expenses, and now it is frozen. You are angry. You demand action. The MIC manager feels the pressure. He has to liquidate the portfolio. He has to become aggressive with the borrowers. This turns the MIC from a benevolent lender into a ruthless debt collector. They start scrutinizing every borrower. Did you miss your property tax payment? Default. Did you let your home insurance lapse for 1 day? Default. Did you make a renovation without permission? Default. They are looking for any excuse to call the loan, seize the property, and get the cash back. The B-lender space is also tightening. Companies like Home Capital or Equitable Bank are regulated, unlike private individuals, but they are also risk-averse. They serve the near-prime market. When the big banks purge customers via the audit, those customers flood the B-lenders. But B-lenders have finite capital. They can't take everyone. So they are cherry-picking the best of the worst. If you have a beacon score under 600, or if your property is in a declining neighborhood, even the B lenders are saying no. So where do these 50,000 borrowers go? They have 3 choices. But choice 1, they find a predatory lender who charges 18% interest and massive fees. This is just delaying the inevitable execution by 6 months. It burns whatever equity is left. Choice 2, they beg family for money. We are seeing a massive transfer of wealth from boomer parents to millennial children just to stop foreclosures. Parents are taking HELOCs on their paid-off homes to pay off their kids' private mortgages. This puts the parents' retirement at risk. It spreads the contagion from the younger generation to the older generation. Choice 3, they sell. And this is the choice that is driving the inventory surge we are seeing in 2026. But selling isn't easy when buyers are scared. Buyers know you are desperate. They smell blood in the water. And if they see a house that was bought in 2022 for $1.5 million, now listed for $1.1 million, they don't think, wow, a bargain. They think, what's wrong with it? Is it going to drop to $900,000? So they wait. The house sits. The private lender gets impatient. They issue the notice of sale. And the spiral continues. There is another frightening aspect to the private lending trap, the cross-collateralization. Many real estate investors used one property to secure loans for another. They built a house of cards. A private lender might have a blanket mortgage over 3 of your properties. If you default on one, you default on all of them. The lender can seize your rental property, your cottage, and your primary residence to satisfy the debt. We are seeing investors who thought they were diversified lose everything in a single legal action. Now, what about the legal system? The courts are overwhelmed. In some jurisdictions, the backlog for eviction hearings and foreclosure approvals is growing. But private lenders have found workarounds. They use uncontested proceedings. If the borrower doesn't respond to the legal papers within 20 days, often because they are paralyzed by fear and shame, the lender gets a default judgment automatically. The sheriff arrives faster than you think. This crisis is also exposing the lack of regulation in the private space. Mortgage brokers are incentivized to close deals. They get paid their commission up front from the loan proceeds. If the borrower defaults in year 2, the broker doesn't have to give the money back. This creates a moral hazard. Brokers push clients into private mortgages knowing they were ticking time bombs, just to get the deal done. Now, Those brokers are ghosting their clients. They aren't answering the phone when the renewal rejection comes in. If you are currently in a private mortgage, or if your renewal is coming up in the next 6 months, you need to wake up to the reality of the market. The extend and pretend game is over. The refinance down the road strategy is dead. You are in a burning building and the exits are being locked. Here is the hard truth that no one wants to tell you. If you cannot qualify for a prime mortgage at a major bank right now, you probably cannot afford your home. The private market was designed for short-term bridges, not long-term residency. Living on 12% interest is financial suicide. Every month you stay in that arrangement, you are transferring your net worth to the lender. When you are working for the lender, you are a tenant in your own home, paying rent that is triple the market rate with all the liability of ownership. The smartest move for many people receiving these letters is not to fight for another loan. It is to sell immediately, voluntarily, control the exit, sell before the lender takes possession. If you sell voluntarily, you might salvage $50,000. If the lender sells, you will get zero. Put your pride aside. The neighborhood doesn't care if you move. The bank doesn't care. Only you care, and your future self will thank you for saving what was left of your dignity and your credit score. But what if you are an investor? What if you are the one who lent the money? You are in the trap too. If you put $100,000 into a private mortgage or an MIC, understand that your money is not liquid. And if you try to pull it out, you might be gated. Or worse, you might realize that the loan to value you were promised was a lie. The property wasn't worth $1 million. It was worth $800,000, and now it's worth $700,000. Your $100,000 second mortgage? It's gone. Vaporized. The first mortgage holder gets paid first. You are holding a piece of paper worth nothing. This shadow bank collapse is the final phase of the housing correction. Phase 1 was the rate hikes. Phase 2 was the trigger rates. Phase 3 was the bank audits. Phase 4 is the liquidity crisis in the private sector. This is where the floor falls out. Because when the private lenders stop lending, there is no buyer of last resort. There is no one to catch the falling knife. We are entering a period of maximum danger. The renewal rejected letter is the new eviction notice. It is happening in the suburbs of Brampton, the condos of Toronto, the townhouses of Surrey. It is a silent purge happening one registered letter at a time. And this leads us to another massive problem that is just starting to surface. What happens to the pre-construction buyers? The people who bought condos 3 years ago and need a mortgage to close next month? They can't get a bank loan because valuations are down. They used to turn to private lenders to close the gap, but now the private lenders are broke. So the pre-construction buyers are walking away from their deposits. They are defaulting on the builders. This triggers a collapse in the construction industry. Builders aren't getting paid. They can't pay their trades. They can't pay their construction loans. We are about to see major developer bankruptcies. This is a contagion that starts with a private lender rejecting a renewal and ends with a skyline full of half-finished towers. In our next video, we are going to dive deep into that specific nightmare, the pre-construction crash. We will explain why 100,000 buyers are about to lose their life savings because of the appraisal gap, and why private lenders are refusing to touch these new condos. The system is connected. You cannot break one part without breaking the others. The private lending market was the grease that kept the gears turning when rates got high. Now the grease is gone. The gears are grinding to a halt, and the sound is deafening. If you have received a demand letter, or if your private mortgage is up for renewal, do not ignore it. Do not hope it goes away. Take action. Consult a lawyer. Talk to a trustee. You'll look at the numbers honestly. The final trap is believing that you can outweight the market. You can't. The market is bigger than you, and right now, the market is calling in its debts. Subscribe to Canada Property Watch. We are telling you the truth that the real estate board won't. We are exposing the mechanics of the collapse so you can protect yourself. The era of cheap money is gone. The era of easy renewals is gone. The audit has happened. The rejection is here. Prepare accordingly.